Hello, everybody, and thanks for joining us this morning for the Collins Street Asset Management Going for Gold, Finding Some Glitter Amongst the COVID-19 Gloom webinar. My name is Rob Hay, and I'm Head of Distribution and Investor Relations. And joining me today is our Managing Director and Portfolio Manager, Michael Goldberg.
Good morning, Rob, and good morning to everybody.
Gold has had an absolutely stellar run over the last 12 months, being up a good 40%. And even this year in 2020, we've seen it rise a good 16%. Throughout the course of today's presentation, we're going to be outlining our investment thesis for gold, a position that accounts for 8% of our Collins Street Value Fund portfolio, as well as do a deep dive due diligence in two of our preferred stocks in the sector. Throughout this course of this presentation, you are able to ask questions privately through the control panel on the side of the screen, and we'll address those as they arise. Now, before we get into the nuts and bolts of today's presentation, I'd like to briefly spend a moment explaining our investment philosophy to you, because this guides and frames our thinking when we're looking at stocks and sectors in the Collins Street Value Fund. First and foremost for us, it is about capital preservation. We believe that it is important to protect wealth before growing wealth, and that in doing so, in gaining superior medium to long-term returns, it's important to genuinely challenge the status quo, challenge the thinking about existing stocks and sectors, and also existing research methodologies. So for us, we tend to look in the path less travelled and try and find an informational advantage in particular stocks and sectors through deep due diligence across the board. This approach has borne fruit. Since inception in February 2016, the fund has performed very strongly, up a good 11.7% per annum after fees over that period. And importantly, coming back to the concept of capital preservation, the fund has actually achieved a positive real return in 63% of the months where the overall market was negative. Given that we started in February 2016, we've seen 19 months of negative overall returns, and during those months, even where the fund was backwards, it still outperformed the broader market by half as much again. The fund is currently rated 5 stars by Morningstar and has outperformed the average of its peer group by nearly 11% per annum over the rolling 3-year period to the 31st of May 2020. In achieving these results, we've promoted a very strong alignment of interests, where quite simply, we don't get paid unless our investors get paid. And so for that reason, we have a natural position where we focus on capital preservation. We don't want to blow up the fund or create any issues where it takes a long time to recover losses. So we have a natural conservatism there. And it also promotes a very careful eye on capacity management. Importantly, we have no external shareholders, so are masters of our own destiny, and can stay true to that investment philosophy, which has been successful over time, and continue to focus on those ideas and opportunities where we see the best value. So without further ado, I'd now like to share our investment thesis behind the gold allocation in our portfolio and share with you also a number of our top picks in the sector. Quite simply, volatility will be with us for some time to come. Over the course of the last 12 months, we've seen flash pans of volatility, be it company-specific announcements, be it trade tensions with China. Certainly over the last few months, we've seen the impact of COVID-19 felt in domestic equity markets. What we would suggest is that moving forward, we're going to continue to see that volatility occur, albeit for a different set of reasons. We're going to have, for example, companies coming back to the market with revised guidance. Now, many of you would be aware that companies were withdrawing guidance quite substantially throughout the May-April period, and we expect there'll be many of them coming back with negative figures as the full impact of COVID-19 is felt on their balance sheet and business model. Alongside that, we have the withdrawal of stimulus coming out of markets towards the back end of this year, which will impact some sectors and some people more than others, particularly when put into perspective of the Australian consumer, which came into this current crisis from a position of weakness with some of the largest levels of consumer debt in the developed world. So we do see a structural tailwind for gold in terms of the volatility piece. But also, if we think about gold more broadly, in many parts of the world, we are seeing negative yielding bonds. In a low interest rate environment, central banks are looking for alternatives, and the opportunity cost of holding gold has been decreasing. And so for that reason, there's been an uptick of buying at the larger end, which has caused an increase of interest in the precious metal. However, we have to separate the outlook for gold as a commodity from our investment thesis behind some of the companies we invest in. Because gold as a commodity and the companies that pick it up and produce it are very different beasts, although they do have a natural connection through the commodity itself. And this can simply be through a combination of exploration and production upside, where companies perhaps have inferred resources under the JORC 2012 standard, which can then be converted up into indicated or from indicated to measured. There's a continuum of classifications there. We can see the impact of quality management, capital management initiatives, and also the impact of various hedging strategies, be it in terms of forward contracts for gold or be it against the US dollar, which is what gold is typically priced in. So if we think then that there is merit in the idea of investing in a gold company rather than the precious metal itself, the question is, where do you go about looking for that? In the current environment, we tend to prefer small to mid-cap ASX listed gold mining stocks. And when looking for them, we prefer those which have got lower levels of debt or debt that we can control, as we say here on the slide. And Michael Goldberg will be talking to an example of that as we go through. We like companies which have got lower fixed cost line items on their expenses. So this can come to wage costs, for example. Where companies are in exploration phase or where perhaps they have to pull back production or scale back for some period of time, it is always easier to do that with lower levels of fixed costs. Naturally, they have to have commercial volumes of gold that they can produce or which they genuinely believe they can move up that continuum from inferred to indicated and the like. A very strong share register, and having top tier joint venture partners or people on your share register absolutely matters. And those names typically evolve with the life cycle of the company as well. When they're moving from exploration, the amount of capital and expertise they need will be very different from when they go into the production phase. And naturally, where you can take the road less traveled with less broker and analyst coverage, then that provides greater opportunity for inefficient pricing, which can be exploited by independent due diligence. So if we have take a step back here and have a look at the top 5 gold mining stocks on the ASX. Now, bear in mind, under the All Ords gold sub-industry classification, there's a good 168 companies which are listed, which range from Newcrest at the top at 24 billion here, all the way down to companies which are on market caps of less than $1 million. Now, these companies here have very good business models. And if we look at Newcrest, for example, they've got a cracking business and they've done well for an extended period of time. They have low levels of debt and certainly low levels of long-term debt. And naturally, as a consequence of that, for a company which is producing gold, they've got a high interest coverage ratio. The issue that we have for companies like Newcrest is the price to earnings multiple of 27 times is a very expensive price to pay, which tends to skew risk heavily toward the downside. And you can see here, out of the top 5, Newcrest actually has the lowest price to earnings ratio of the group. Price to book can be an interesting measure to look at, although it really does depend upon the maturity of the company and their exploration pipeline. Because unless you know how much they actually have in gold in known reserves, it can be very difficult to place a price on that book. And so for that reason, we tend to prefer companies, yes, with low levels of debt, but ones which are trading on attractive price to earnings multiples or which have particular upside, which is unappreciated by the market. And the first stock today that I'd like to share with you is Nova Minerals. On the ASX, this is listed under the ticker code NVA. And at this point, I'd like to pass across to Michael Goldberg, who'll share some of his insights into how he came across this company and some of the things that he looks for in gold stocks more generally. Michael, over to you.
Yeah, thanks, Rob. I think you've done a really good job describing what we're looking for and how we consider the gold space in general. But when it comes to picking specific gold companies. What we tend to look for are companies with high grade deposits with low depth mineralization, and that's not just for its own sake. That will obviously influence the cost of production. We also look for teams of management to align their interests with their investors. It always makes it easier to trust that a management team will do what's in your best interests if it's also in their own best interests. We're looking for companies in safe jurisdictions. We've heard plenty of stories of governments deciding to take over mining sites, or even gangs in some South African areas where they've turned up with AK-47s and jeeps and stolen deposits or taken some of the gold away from the miners. So safe jurisdictions like the Americas or like Australia are very, very key and an important factor that we consider when we're looking at different companies. And of course, historic data. I think often people don't fully appreciate the value of historic data, not just so that companies can establish where the reserves are, but also, especially for small and medium cap size companies, where the cost of drilling is such a meaningful expense, working out or knowing where the gold is not can often be as important as knowing where it is. And then of course, access to infrastructure. I mean, as you can see from the chart in front of you, and as is often the case with gold companies, these businesses, these mine sites tend to be in the middle of nowhere. In Alaska's case, if the grizzly bears don't get you, the cold certainly will. And so being close to infrastructure is keenly important. In Nova's particular example, they're fortunate enough to have an established airstrip on their site, so they can bring in assets and products and whatever they may need. They've also established a campsite there so that their staff can spend the full year there if they choose to. And they've recently come to an agreement with Donlin Creek, who you can see to the northwest of the Estelle project, to tap into their pipeline at some point in the future. And of course, probably more important than anything else is making sure that you're paying a reasonable price for the assets that you're buying. And as I've often said, a good business can often make a terrible investment, and a reasonable business can often make a wonderful investment. And as Rob pointed out, with some of the large cap companies, while they are obviously fantastic businesses and I would love to own them at some point in the future, it's difficult to justify paying a PE of 30 times for that particular business. A PE of 30 times essentially means that it will take me 30 years to get back my investment in that company, which for me seems a little bit much. So as you can see from that, the yellow marking on that chart, the area is extremely rich in gold. In fact, the region identified by that illustration has some 222 million ounces of defined gold, which is huge. It makes it one of the most important gold regions in the world. And in fact, if you take a closer look just east of the Estelle project, there is a Northern Dynasty project there called Pebble, which has 107 million ounces, which makes it the single largest project in the world. So what makes Nova a little bit different to your standard gold project is that they've got what's called an intrusive gold system. So instead of what you might think of as a traditional gold mine, where you identify the vein of gold and then you follow that and clear the dirt and access that particular vein, and then you follow it for as long as you can, an intrusive system is one where every shovel of dirt will have some mineralization within it. So over time, the geology has seen the gold break up, and instead of having a vein, there are these vast regions, these vast areas where everything underneath it has some gold, which obviously means that there's a lot more dirt being moved to access that gold, but it is also much more easy to access it. So what they've done is instead of creating or instead of processing their mineralization and their asset through a traditional mill, which is obviously quite expensive to build and then requires crushing of rock and then leaching and dissolving in cyanide, which can be quite a costly exercise, including in energy and time. What Nova have done is they've established what's called a heap leach pad, which basically means it's some very basic technology. They pile all of their dirt on top of what is essentially a pad. They treat it with a leach, and then by way of chemical reaction and gravity, they tend to be able to extract around about 75 to 85% of the gold from that pile, and it comes out on the bottom end, like I said, through gravity and through the chemical reaction. And that's an extremely cheap process. So estimations from the company have suggested the cost of production, and again, this is based on some experience that I've seen from some nearby neighbours, in particular Fort Knox, which is again northeast of the Estelle project, suggestive that the cost of production will be around about $750 per ounce. Given that current gold is trading at about 1,725, those margins are quite significant. So again, it looks like an appropriate and an attractive approach to mining gold. They've identified at one of their projects in the northern end of their region some 2.5 million ounces of JORC compliant resource. And keeping in mind, that's just one section out of 15 areas that they've identified do have mineralization and are interesting regions for further investigation. But if you take that into consideration, you think about the fact that they can, or they expect to mine around about 100,000 ounces per annum, starting from about 2023, 2024. And given the margins that they're expected to make, their payback on a fully diluted market cap, which is currently sitting at around about 100 million. Again, this is dependent on ongoing capex and opex, but their payback on an investment in this company looks to be around about 2 to 3 years. Which makes it look far more attractive than some of the larger companies, which, as we've already identified, are trading on multiples of 30 times earnings. So those are, I think, probably the key factors that draw our attention to Nova Minerals, and it's why we think that we'll do quite well out of our investment with them.
Thank you, Michael. And so to put this into perspective, this is the size of the Estelle project, and the Corbell deposit in particular, which is the priority for the company, is located here toward the top end of that. Now, this is where the 2.5 million ounces of inferred resources sit. However, they do have, as Michael pointed out, 15 targets across their tenement, which they're able to explore. Now, bear in mind, they've only explored roughly 2% of their entire tenement. And based on historic drilling data, there are these 15 opportunities which they have available to them, and seams which are open, gold, which is open for exploration in all areas. So over time, Nova Minerals will be aggressively expanding their drilling projects so that they can increase their data density and then move from that inferred part of the continuum up to indicated and firm up those resources, but also expand the amount of resources estimated within that deposit. This particular table here shows the inferred resource model, which brings up to the 2.5 million gold ounces that they have. Now, this here is based on grams per tonne of 0.429. And as Michael said, their process for extracting that gold will see roughly 3/4 of the gold achieved as a result of that refining process throughout the conversion. Now, that is a very good number, certainly not as high as what you might see in other mines. However, the margins that they're able to achieve by this process are typically north of 50% on their method of extraction. So it's a very, very lucrative opportunity for them. Over time, as the 15 additional areas are expanded upon and more data density is achieved to bring more resources up to JORC 2012 compliance and move along that continuum, the value of the project will increase and naturally the level of risk will decrease. And so where we see them coming into production over the next 4 or 5 years, there'll be a strong flow of news which will drive the stock over that time. The question, of course, is how does one get set in a company like Nova Minerals? And recently we established a position, and this ASX announcement from the 28th of May provides some overview of that. But perhaps I'll hand back over to Michael Goldberg, who'll share some of his thoughts on this opportunity.
Yeah, thanks again, Rob. I think given that one of our key themes in the way that we run our business being that our main concern is capital preservation, whenever we're looking at any kind of investment, we're weighing up the risks against the potential benefits. And so what we had here was an opportunity to provide a prepayment funding facility, which works somewhat like a convertible note. We provided $2 million up front, and we have the right to convert that payment into shares over time. But the reason we like this sort of thing is that it provides us the vast majority of the upside potential if things go as we expect. And this is a company obviously that we support and that we're keen to back, and we wouldn't invest in any way in a company that we weren't keen to support and back. But again, providing a structure or being able to negotiate on a structure where if things don't pan out in the timely fashion we expect, we would have an option to exit our position without taking a loss. So this sort of structure allows us to get the vast majority of the upside potential of a company, while at the same time providing us with some protection should things not pan out as they expect. If things take longer than expected, we have the right over the next 12 months or so to convert our prepayment funding at a discount to what we think the company's worth, or in a worst case scenario, which we don't expect is likely to occur, we could even ask the company to pay us back in cash. So again, this is another example where we've been able to negotiate directly with the companies. This is not the first time, and hopefully it won't be the last time, to give us access to a business that we do like, that we do support, and that we do think has tremendous prospects, yet at the same time, providing ourselves with downside protection.
Thank you, Michael. So changing tack now, we've gone from one company, Nova Minerals, which is in the exploration phase, to Ora Banda Mining, where the ASX code is OBM, which is very close to coming onto production. Ora Banda Mining is a very interesting company. We like them for a number of reasons. Least of all, they've got a very low capital hurdle. They've got a very short term to production, and there is substantial exploration upside in the company. They have a market cap of around 150 to 160 million, but bear in mind that the Davyhurst project, which is their flagship project as it currently stands, has established infrastructure, processing plants and camps and the like, which is valued at around that $150 million level. They're based in the eastern goldfields of Kalgoorlie, and recently, for those who follow gold and gold stocks, you may have noticed they've upgraded their Davyhurst reserve by 60% to 330,000 ounces. This is very substantial, and if we have a look at some of the particular deposits which feed into this, Riverina, Waihi, Callian, Golden Eagle and Siberia, they are also at very advanced stages. So take, for example, Callian. They have 96% of their reserves are in the indicated range, which is further along that continuum. And we're expecting an update from the company later on this month as part of their definitive feasibility study, which will firm up some of those numbers a little bit further. This particular slide talks to some of the drilling that's been completed, the amount of mineral resources that are anticipated and the stage that the company is at. As you can see, they've got some very strong numbers here, and they've got a diversity of sources which they're able to tap into across the board. What we have seen, which has also been quite pleasing, and if we have a look at Callian as one example of that, they've had a good 50% conversion between indicated and measured, so moving up that continuum. So the numbers that they have been quite strong and are proving to hold up as they expand their data density and finalise their drilling and exploration in that area. This slide here provides an overview of the exploration upside for Ora Banda Mining. You can see here that they've got 46 different areas that they're looking at various stages of progression. So whilst they're looking at coming online with production, and Michael will be talking to that in a few moments, alongside that they do have exploration upside, which is further blue sky for the company as that progresses over time. This slide here shows the project chart of how the Davyhurst project will be managed over time and some of the news flow that can be expected out, which will drive the stock. Naturally, for companies like this, which do have a very strong handle on costs and do have a substantial amount of known resources which they're able to bring onto production very shortly, it takes a lot of risk out of the stock and is one which we're very confident in. Michael, perhaps you could share some of your insights here into the cash flows behind Ora Banda Mining and what it is you like.
Yeah, I sure can. And I think starting off, it's probably worth noting that Ora Banda has done a wonderful job since inception. They were actually able to purchase these tenements and the facilities out of the liquidation process. So just looking at the cost replacement of the processing plant and the facilities that they've gained access to, that's probably worth about $150 million. And they were able to access all of that and purchase all of those tenements and equipment for something like $30-odd million. So they've done quite well to start off with, which gives us tremendous faith in management. I think it's probably worth noting as well, as you mentioned, that they are looking to get into production in 2021, not just 2021. They're looking to get into production as early as January 2021. And when you're looking at any kind of miner, you have to wonder what's it going to cost to ramp up from their current level of operations into the next level of operations where they can actually start producing gold and selling it into the market. And the answer is, as always, there will be a capex. There will be some capital expenditure required to brush off the cobwebs of their existing processing plant and get things moving. But it's not as bad as all that. I think they'll probably need to raise around about $30 to $50 million, giving the company an EV of around about $210 million. But it is very much worth noting, and I think Rob, you might have pointed out, that they have some major and very supportive shareholders, one being Hawke's Point Holding, who are a big outfit, who have already expressed an interest in potentially providing a substantial part of their funding. And if you consider it just from a pro rata perspective, if they did say have to raise $50 odd million, given that Hawke's Point have already put their hand up to provide their proportion of funding, all of a sudden that $50 million raise would fall down to $25 million. And of course, they've also received lots of interest from potential JV partners and parties who would be prepared to provide funding on a project level. So looking at their grades and their depths, very, very attractive, more of a traditional type of gold miner, high grades at low depths, which means again that their cost of production is going to be relatively low. They do have, as we mentioned, that processing plant, the conventional processing plant, which they run through, they dig up their mineralization, they deposit, they crush it, they run it through the gravity circuit, through the cyanide, they dissolve the gold, and then on the other end out comes your gold bars, which you send them into, then refine it even more. But their cost of production, I think, is going to be around about 1,000 to 350 Australian dollars, which again, relative to the current cost of gold in the market being closer to $2,400, we're once again looking at a company that are likely to have between $80 and $90 million worth of free cash flows in 2021, and that's quickly going to grow to 100 million plus from 2022 going forward. So again, we're looking at a company right now with a market cap of around about 150, $160 million, with the potential need to raise another 50 odd, making it worth, let's call it 210, that could pay back all of the cost of its market cap and future raising within 2 years. So again, it's another example of a company with high grades, low depth, a management team that we believe we can trust in a safe jurisdiction in the middle of nowhere, Western Australia, with great historical data, access to infrastructure, which is key, as we said. And again, the key question is always, are we paying a proper price for it? And the answer seems to be yes. It looks like we're paying a very, very appropriate price given the expectations that the payback period would be in as little as 2 years. So another wonderful, wonderful business that we are proud to be supporting.
Thank you, Michael. This slide here shows the value over time of our gold basket, represented in blue, compared to gold, which is a physical commodity, and also compared to, in the green line, the large cap stock portfolio. So this is showing a basket of large cap names, which we had earlier on in the presentation. As you can see here, over time, there has been some initial divergence between the small to mid cap names and those in the large basket, whereas the price of gold has gone up rather steadily over time. What we find is that where money moves from the large cap space over time into the small cap space, there can be a greater impact on share price returns, as you can see in this blue line. So having those small to mid cap names, which have been a lot more punchier, a lot more attractively priced, and a lot less researched, has certainly provided that gold exposure and provided some great returns from great businesses across the board. More broadly, the Collins Street Value Fund is sitting on about 32% cash. That number will have come down quite a bit, I would have thought, over the course of the last couple of weeks as we've added some new opportunities into the fund. But we also have exposure to financial services, pharmaceutical companies, consumer, uranium, and the like. We are a high conviction, unconstrained fund, so we don't attempt to mirror or replicate an index by any stretch of the imagination, and we're sitting on 20 individual positions in the portfolio. This slide here shows some of the other names that we have outside of our gold basket, as well as some of the key characteristics that we look for when assessing any company. And again, coming back to that low debt to equity, low price to book, known assets and quality management. In closing, I'd like to suggest that it's very important to protect your downside. As I mentioned at the start of today's presentation, we sit on about 8% gold in the portfolio compared to the ASX All Ords, which is about 3 to 3.5%. And it's important to protect that downside through careful pricing and execution. Don't pay too much, because you can find that even with your gold exposure, your risks will be skewed to the downside. You can maximize your upside through careful research and genuine conviction in what it is you do, and by taking a larger position in those companies that you've thoroughly researched and which you can have confidence in management to deliver upon. And of course, having gold as a hedge against volatility is absolutely important, because volatility is likely to be here for some time. And for that reason, having that level of protection in the portfolio can be very valuable in preserving your wealth. From here, we provide regular updates. For those of you who are not yet receiving our quarterly report and would like to do so, please let me know. I'd be happy to make sure you receive a copy of that. We'll also be looking at doing another webinar in July, and naturally we're available for video conferences, phone calls and the like upon request to cover off on any aspect of our fund or today's presentation that might be of interest to you. For those of you looking to make an investment pre the end of this financial year, we are a monthly priced fund, so the cutoff date for that would be the 30th of June. My contact details are on this slide here, and I'd be more than happy to have a chat with anyone individually should they wish to reach out and do so. Many thanks for your time today. I'm about to launch a quick poll. If you could be kind enough to provide your feedback so that we can ensure that the content that we're providing remains relevant and up to date, it would be very much appreciated. I'll leave this open for a moment or two so that you can cast your vote. But once again, many thanks for your time today. If you do have any final questions, please feel free to put those through in the panel and we can circle back accordingly. Thanks a lot.